Hello, everyone. Welcome back to the tech stage. If you want to follow what's going on here, please put on a pair of these headphones. They're just at the back there. Elaine has them. Put those on, and you can follow what's going on here. Without these, it's going to be really hard to hear. For those of you who've just joined us, this is the tech stage. This is where we do deep dives on technical issues. Main stage is over there, and on the rooftop is our chill out lounge. Anyway, without further ado, we're going to welcome Joshua Deems from Figment to come and talk about how you get Bitcoin rewards from publicly listed instruments like ETPs and ETFs. Welcome, Joshua.
This is a pretty surreal experience. I don't think I've ever attended a silent disco before. And now I'm speaking to you all for 30 minutes. My first ever silent disco experience. So this is great. It's a pleasure to meet you all. My name is Josh Deems. I work at Figment. Figment is a staking as a service company. So we help companies, businesses via API or directly stake their crypto assets. And we've been around since 2017. And I've been in the space since 2014. So previously was at Fidelity, State Street, and now I work at Figment. And my role is to help bring the crypto native experience, the staking experience to institutional products like ETPs and ETFs. Very quick disclaimer. This is not financial advice. And without further ado, let me just dive into it. So Figment, very briefly. We have over 500 clients. We work with 27 different wallet providers, over 130 employees. We have 15 billion assets under stake. So we're one of the largest independent non-custodial staking providers. And really, our goal is to build better blocks. So we build blocks across all ecosystems. We support about 30 plus different blockchains. And we provide the staking rewards, the validator experience so that our customers don't have to do that themselves. So what am I going to talk about today? I'm going to give a little bit of like a macro background on the foundation that led to the Bitcoin ETF and the success of the Bitcoin ETF. I'm going to talk about why someone would care about a Bitcoin ETF. I'm going to talk a little bit about the under the hood rewards or dynamics of an ETF. And then lastly, I'm going to talk about a rewards optimized Bitcoin ETF. So if we could go back in time and maybe redesign the Bitcoin ETF that is now the most successful launch in ETF's history, what can we do different? How can we even make it a better product than what it is today? So first principles, kind of to go into a macro analysis as to why the Bitcoin ETF was so successful. Why would anyone buy any asset? There's kind of three primary reasons if you study the course of financial history that get called out. The first is capital preservation. I don't want to lose my net worth. The second is income generation. I want to use my net worth to create more net worth. And the last is growth. Find new cool opportunities that multiply my net worth. And I love this quote from Mohamed Al-Arian, who's the former CEO of PIMCO and also a Bitcoiner. In a world of scarce yields, investors are increasingly forced to stretch for returns, often venturing into riskier and less liquid areas of the market. I think with the advent of the Bitcoin ETPs and ETFs, that we can deliver scarce yield, we can deliver a stretch for returns in a less risky and more liquid area of the market. So what's kind of the macro environment in the United States like leading up to the launch of the Bitcoin ETP, ETF? The first is, if you look at wage growth over the last 50 plus years, we've been in a steady decline relative to the economy's total income. We also have the 10-year real treasury yield and gold prices going in separate directions, right? So the treasury yield, the 10-year treasury yield, is the most commonly used benchmark of the health of borrowing from the government. It influences things like your mortgage rate, your car loan rate. And the spot gold price is generally gold is historically the instrument that people use to express kind of a safe haven asset prior to the advent of Bitcoin. And you've seen this divergence really, kind of the year or two after COVID hit. And so our capital, our wealth is worth less. It's more expensive to buy things. And so people are naturally looking for ways to preserve that wealth so they'll have it when they retire or when they need it. The second is income generation. So the charts are the return to the S&P 500 by dividend growth. So dividends can kind of be an interesting proxy, and inflows into dividend yielding stocks and ETFs can be an interesting proxy to just understand what investor demand for yield bearing assets look like. Dividend growers and initiators significantly outperform an equal weighted S&P 500 index. And this is shown by, if you look at the demand of a total return index, an index that has all components of dividends captured versus an index that doesn't capture dividends or doesn't reinvest dividends. Obviously, it's very, you can see in the chart, you're going to do much better by being in a dividend growth fund. So people tend to look for sources of growth, income generation, putting their money to work to generate more money. The second thing is we have on the right-hand side ETF AUMs by bond type. And so to really show you how and why investors are looking for new sources of yield, the purple line is corporate debt. It's the riskiest type of debt that you can invest in. Corporate debt has seen an absolute massive amounts of AUM increase, new products being launched relative to other parts of the bond market. It shows that investors are looking to generate sources of income or are willing to go a little bit further out on the risk curve to get that source of income that they're not getting from, say, the 10-year treasury. I think lastly, we look at the growth aspect. So on the left-hand side, this is the 60-40 model portfolio. When go to finance class or you meet with a financial advisor, they're like, we're going to put 60% of your portfolio in stocks and 40% in bonds. That's basically dead, and it's been dead for some time. If you look at large institutional allocators, both at the state and private level, pension plans, they tend to put almost 30% of their investment allocation into alternatives. Alternatives, things like REITs, real estate investment trusts, things like hedge funds, venture funds, but also commodities, crypto. Crypto fits very squarely into an alternative asset allocation. On the right-hand side, we're also looking at the percentage of the global investable market that's going to be taken over by alternative investments, and that's expected to be around 25% by next year. So we're really seeing this convergence where people are divesting equities, they're divesting a bit from fixed income, and they're moving it into alternatives. So kind of to summarize that quickly, we have wages declining. We have the cost of living at a new all-time high almost every day. We have investors who historically seek high dividend stocks, AUM pouring into high yielding bond ETFs. We have pensions. Pensions are seeking new sources of growth because they're underfunded and they have this huge swath of boomers that are retiring. They're going to have to meet those obligations. And so by 2025, we're expecting alternatives to be nearly 25% of global AUM. And so these are the conditions that led to what I believe the greatest launch of, or maybe not even what I believe. I think it's well understood that the Bitcoin ETF was the most successful ETF launch of all time. This chart's dated, but the orange line is obviously Bitcoin. By just 1 month into Bitcoin's existence, it significantly outperformed GLD, which is the gold ETF, which was the previously most successful ETF launch, commodity-based ETF launch of all time. So if we go back to the original quote that Muhammad Al-Arian had told us about preserving capital, sources of yields, getting riskier and riskier going further out on the risk curve, does the Bitcoin ETF actually accomplish those goals? Well, yes, there's capital preservation. Bitcoin has $21 million supply cap, 21 million unit supply cap. Miners get Bitcoin issuance, but there's no actual income that flows back to the ETF holders or the ETF issuer. So really not an income generation play. Is it a growth play? Maybe, right? Does Metcalfe's law apply to the Bitcoin price? We'll see. That's something that's not determined. So let's talk a little bit about what an ETP is, an ETN is, an ETF is, and what I usually say is WTF because it's all kind of crazy acronym jargon. But an exchange-traded fund and an exchange-traded note or commodity are two kind of different things. An exchange-traded fund is an investment fund. It tracks an index or a basket of indexes, and it owns the assets it holds. The S&P 500, the SPDR ETF, for instance, Very good example of an ETF. It's 500 different indexes. It's 500 different stocks. It's indexed to the performance of those stocks. An ETN or an ETC is a collateralized debt instrument. It tracks a price or an index, but usually spot commodities. It also does not own the assets that it holds. It's usually one-to-one backed, collateralized with the underlying. So just very briefly to give you a difference, you'll hear these terms used interchangeably all the time. In the US, we actually technically have ETFs, the Bitcoin ETFs, but they actually act a little bit more like an ETC. So a little bit too technical, but really that's just to kind of give you an overview. ETPs, we were all super hyped when the Bitcoin ETP was launched, obviously, but ETPs aren't that significant a part of the global capital markets yet, and that is changing. The trend is obviously diverging and moving upward. In the US, we're about 30 plus trillion dollars in the equities markets. Only about 13% of that is in ETPs. In Europe, it's even smaller. APAC, it's even smaller. So again, the concept of an ETP and ETF has really only been around for about 25 years. And so, increasingly growing and becoming a more important part of global capital markets. We have in the crypto space about 250 enlisted products. So we have, the initial product was a product in Europe that launched in 2015. But there's about $82 billion of global AUM, including the Bitcoin ETPs, and 77% of that is in Bitcoin-based products. So overwhelmingly in Bitcoin products versus other baskets or Ethereum, et cetera. This is just a chart to show, look how much growth we've had in the last 2 years in the digital asset ETP, ETF space. Obviously, a lot of this is taken into account the Bitcoin ETFs. We have billion-dollar products in Europe that track Solana or Ethereum or baskets. And so this whole space is growing. And I'm going to tell you a little bit why someone would prefer to invest in an ETP or an ETF versus holding spot directly. So a lot of times we're told that ETFs are training wheels for future hodlers, right? You don't know how to set up a wallet address. The whole goal is to get more people on chain. And that's great, but on-chain doesn't work for all people and it doesn't work in all circumstances. So why would you buy an ETP? And I love this quote from Matt Hogan, who's the CIO at Bitwise, one of the Bitcoin and Ethereum ETF issuers, that crypto ETFs are bridging the gap between traditional finance and digital assets, providing people with a familiar and regulated way to gain exposure. So what does that really mean? From a regulatory perspective, whether you're launching an ETF in the United States, an ETP in Switzerland, or in Hong Kong, you have to go through the approval disclosures and transparency standards as other fund managers. So you have to present a prospectus. You have to present a filing. Everyone knows who the service providers are. So there's regulatory oversight that you don't have, obviously, if you go ahead and open your own wallet. There's access. So these are listed on familiar exchanges, right? The New York Stock Exchange, the SIX exchange, the Swiss exchange, which has the majority of these ETPs actually listed, et cetera, in Germany. And so that allows people to actually go in and buy the Bitcoin ETF or any sort of ETP product through their brokerage account. They can log into their Robinhood account or their Interactive Brokerage account and buy shares of an ETP or an ETF without having to fund an exchange or put a balance in at a custodian. That's handled for them behind the scenes. From a liquidity perspective, these products are really interesting because they trade in a very, very tight spread, very, very little slippage, especially in the more liquid products. So, one of the challenges that we have when buying and selling crypto on the open market, on the exchanges that we're familiar with, there is slippage at higher order amounts, right? If you want to go buy $50 million worth of Bitcoin, you have to submit a certain order type that happens over a period of time. With an ETP, it happens a lot more easily, and that's because these market makers play a role in buying and selling the underlying asset in most cases. Holders also bypass blockchain unbonding periods. If you hold stacks, Bitcoin or stacks, Ethereum, Solana today, there's an unbonding period where your tokens are earning rewards for you, but they're not liquid if you wanted to sell. From a liquidity perspective, an ETP has in Europe T+2 settlement, in the US settles T+1. And the assets are fully backed one-to-one by in-kind collateral. So That allows people to get borrows or to lend against the ETPs in a regulated market using large banks, et cetera, as as the source of borrow or the source of lend. Whereas you can't do that with the cryptocurrency markets. Banks can't touch um, um, direct crypto collateral today. And lastly, from a tax perspective, I mean, the main advantage, right? Bitcoiners here or people who are interested in this space, if you have a US retirement account, you can't hold Bitcoin, you can't hold Ethereum, you can't hold stacks directly in your retirement account. You can hold shares of an ETP. So the eligibility in a US retirement account and a European brokerage account, it's even more interesting because there's some tax advantages that you gain from holding an ETP versus holding crypto directly. And it is much easier to track your gains and losses. If anyone here has gone through the process of staking or stacking and um, having to file taxes at the end of the year, an ETP makes that much easier to do. Your broker is basically giving you a statement. Who actually bought the Bitcoin ETFs? Like there was obviously, almost $50 billion of inflows. Who's it coming from? And why are they buying? Hedge funds were about a little less than 10%, but they're not buying because they're believers in the future of Bitcoin. They're buying because of this trade advantage that they see, where they buy the Bitcoin ETF long, and then they short futures. The Bitcoin futures trade in contango, which means they trade less than the spot price of Bitcoin. So every month or every 3 months, a hedge fund can buy the futures or can short sell the futures, buy the Bitcoin ETF, and then short sell the futures and print sort of 5%, 5 to 10%. So it was great that we had, these large, like the half of the 25 largest hedge funds in the US bought the Bitcoin bought the Bitcoin ETF, and they did so for this purpose. Where it gets more interesting is when we get into the RIAs and retail. RIAs are about a little over 5% of the market. They're buying because of customer demand. Fidelity Canada came out publicly and said that the ideal range of Bitcoin in a portfolio is somewhere around 3%. So you have these RIAs, these registered investment advisors, that are making, directional bets, telling their customers that we think that your portfolio can be enhanced by adding this much Bitcoin to it. They can express that in the form of the ETF much more easily than they can by buying Bitcoin directly. And so where do we get the remainder, right? The 47.6 billion? Well, it's likely retail. We don't know for sure. We know hedge funds, we know RIAs because they're forced to produce a statement called a 13F filing with the SEC if they manage over $100 million in capital. And that 13F statement tells us kind of who's bought the ETF. But there's this huge bucket that we don't know. So we kind of make this assumption that it's retail. And these are people that actually believe in the Bitcoin narrative, or they've been told about Bitcoin and they don't have a negative perception of it. There's a growth narrative and they see its performance relative to other asset classes. It has outperformed. It's been one of the best performing assets year over year since its existence. But for many reasons, either they want to hold it in their retirement account, or it's someone like my parents who, I'm not going to go ahead and set up a wallet for them and have them manage private keys and manage that whole process. They can bypass it by simply just logging into their brokerage account, their Fidelity account, whatever, and buying the Bitcoin ETF. So the Bitcoin ETF is a great product, but it's not perfect. So how could we make it better? First, efficiency. It uses what's called in-kind transfers, which introduces complexity and risk. It's very simple, but when you're buying shares of the Bitcoin ETF, you're basically submitting an order to a market maker. That market maker goes out and acquires acquires the cash, delivers the cash to the issuer, and the issuer goes out and buys Bitcoin. So there's kind of a lag there between the actual purchase, you buying the spot ETF, and the ETF actually collateralizing itself with the actual Bitcoin. It can impact fund performance. It's not perfect. In an ideal world, they're actually delivering Bitcoin in kind to the issuer, the market makers are. And this actually creates a huge problem because existing Bitcoin holders cannot subscribe in kind. They must purchase the shares net new. So if you have a bunch of Bitcoin, you wanted to roll it into an ETF for whatever reason, put it in your retirement account or tax advantage account. You can't do that because you have to buy the shares with cash. And lastly, the Bitcoin ETF, this is just a Bitcoin thing, but Bitcoin is a commodity. Its price is influenced by supply demand, geopolitical events, currency movement, speculation. There are macroeconomic forces that change Bitcoin's price. And so Bitcoin's price needs to go up in order for the net asset value to grow. There's no function of Bitcoin that makes more Bitcoin appear. Just very quickly, like you can even see the difference on the right-hand side of the screen, the difference in performance between all the Bitcoin ETFs. You'd expect them to be the same, but some of the dislocation, the delivery mechanisms, the custodial costs, et cetera, it causes them to actually not trade at the same exact price. Their performance is a little bit different. And so, there's, again, something to pay attention to, something to consider when you're exploring the Bitcoin ETFs. But what do we really want to get out of this? What do we really think is the best way to revolutionize the Bitcoin ETF? It's adding stacks to a Bitcoin ETF. By adding stacks, you can create a Bitcoin production flywheel. You can put stacks to work to create more Bitcoin in a passive product. The way most ETPs or ETFs work is you have a share, one share, and it's backed by a number of Bitcoin or a number of Ethereum. But with the Bitcoin products, that number never increases. If you put stacks in a product, you can increase the number of Bitcoin that each unit is backed by, but creating this flywheel to create more value for the investors who are essentially buying the ETP. Stacks in Bitcoin has a 93% correlation coefficient, means they trade in line 93% of the time. One of the arguments to this theory is that, stacks is not as, it's newer than Bitcoin. It's a little bit more volatile. You could even hedge that, right? There are obviously many ways that you can hedge that. You can use SBTC, puts, shorts, et cetera, so that you actually create a Bitcoin hedged product that generates more Bitcoin for the end holder. New Bitcoin flows back to the product nav, as I was saying, and then each ETF share is worth more Bitcoin over time. So this is my portfolio theory 3.0. We're in Web 3.0, and I think it's time for portfolio theory 3.0, putting stacking into the Bitcoin ETF to supercharge it. Across the bottom, there are all the different issuers. There's IBIT is BlackRock, GBTC is Grayscale, FBTC Fidelity, so on and so forth. BlackRock generates roughly $50 million a year off of the fees that they're charging their customers for simply creating the Bitcoin ETF for them. BlackRock could create almost $300 million in revenue if they were to take the same size product and stack 20% of it. So across the board, you kind of see the revenue discrepancy between a product like BlackRock's, like Grayscale's. Grayscale's is a bit different because it was a conversion of an already existing pool of capital into an ETF, Fidelity, and so on and so forth. And so if we go back and think about the very beginning of the presentation, the three things that investors care about. Investors care about capital preservation, income generation, and growth. Is capital preservation accomplished? Yes. Bitcoin has a supply cap. STX has a supply cap. Is income generation accomplished? Yes. Stackers would get some form of Bitcoin issuance. Is growth accomplished? Arguably, yes. What is going to increase the usability of Bitcoin that's going to bring more people into this space? It's building on stacks. And so by adding stacks into the product, you could increase both the capital preservation narrative, the income generation narrative, and the growth narrative. So it is in my opinion that over time, this is going to be the way that all ETPs and all ETFs operate in the crypto space. That you will have a rewards component because the rewards are the lifeblood, the operating system of all of these different protocols. It is a security layer. It is the activity layer, is the app layer. And so why not have exposure to something like that in an ETF so that you're not only benefiting the asset, you're not only benefiting from owning the asset, but you're benefiting from the activity and the growth that's happening on top of the asset. So at Figment, we're working really closely with a number of institutions, helping them power the staking in their products. And there are a number of products across the globe that are doing this today. And we're working with folks in places like Switzerland, products that are listed by a company called Issuance.Swiss. We're working with folks like 21 Shares. We're working with folks, here in the United States. But really, I think that the growth potential in this space is by, if we really want to think about the onboarding problem that we face and bringing Bitcoin and stacks and these protocols to the masses, it is through a wrapper like an ETP or an ETF. It is with the same benefit that we who are crypto native understand how to achieve by staking. And I think that's going to revolutionize the world of finance and create this new portfolio theory 3.0 that we see today. So that is it. I am happy to, is there an option for questions if people have them? So yeah, can open it up for questions. All right. Yeah. Oh,
How volatile? Okay, how volatile will it be if you changed the matrix from like 70 or 80% stacks to like 90?
so the model that I showed was actually only 20% stacks. So if you went to 80 or 90% stacks, I mean, you're yeah, 3xing revenue on the product. I mean, the revenue that BlackRock is earning is around 25 basis points on roughly 18 to 20 billion dollars worth of AUM. And so I included that still in this number. In the future though, that's a rounding error to the profitability of this product. You could almost offer a free product if you're an issuer and you're stacking. You could create some differentiation where I don't think the products today have a ton of differentiation because they're merely just tracking the same general index. So yeah, if you increase the stacking percentage, you could 4x, 5x the revenue opportunity.
What do we know about the regulatory environment in the US for staking within these types of products?
So we had the Ethereum products launched 2 days ago, second most successful ETF launch in ETF history. And we'll see kind of how that plays out. But in the first 2 days, about $500 million worth of net volume. And that's with the huge outflow of the Grayscale product. In the US, the SEC has not come out and explicitly said how they think about staking. There's a couple things that we're monitoring that we think are positive in the fact that the SEC might get comfortable with staking in a product, something like Stacks or something like an Ethereum product. The main thing that we're tracking is the lawsuit against Consensus and whether or not Ethereum 2.0 is deemed to be a security or not. That portion of the lawsuit was actually dropped. So that gives a lot of hope that maybe the SEC is standing down from its position. A lot of the stances that the SEC has taken has been against pooled staking programs where staking is managed as a pool. There's sort of smoothing of rewards. There's some entrepreneurial effort happening there. When you're directly protocol staking, there's no intermediary that's determining what the rewards are. So I think if we get louder and clearer about that message in Washington, then we could probably have maybe this SEC, maybe the next, right? It's obviously, interesting what's going to happen there, but there is definitely a world where we see that staking comes to products in the United States.
You mentioned before that there's a redemption period of T+2 or T+1, so that you don't have to be exposed to the unbonding period when something's staked or stacked. How does it work? How do you make sure that somebody that's invested in an ETP is actually able to sell without the unbonding period?
It's a question that you should ask or look into the ETP issuer of what they're doing when they go ahead and launch a product. Like when we think about products, we think about having a line of, we don't launch the ETPs ourselves, but the folks that we're working with, like folks like I mentioned before, they will get a line of credit, or they will work with a market maker or someone to use the staking position as collateral. So the most forward-thinking ETP issuers are going to be doing that. They're going to be exploring ways that they can offer collateral so that they can, swap out a staked position for an unstaked position and be able to meet the liquidity or the redemption because of that. But yeah, that's a good question, and something that you should make sure that if someone is providing staking rewards in a product, definitely look into how they are meeting the liquidity needs if there was going to be a large unbonding event. Awesome. Thank you, everyone.